25% of my holdings in the market are penny stocks. Why? Less risk. Sheltering dividend returns instead of going into cash. 50 to 75%. The political climate is volatile, but the market is stable for now. Increasing my shares in the market with growing companies is much better than letting the cash sit in some account. The other 75 will float from 45 cash to 55%, taking advantage of the ups and downs, standard operating procedure. Welcome to Stock Review, ladies and gentlemen. Been away for a while, and for good reason. I've been trading and coming up with new ideas, new strategies. As far it's new to me. The less and less I the less and less I listen to the competition, the better things are for me. Totally noticing this. What we have right now is Sky Solar engaged in the acquisition of acquisition and sales, developing solar parks. Asset class number 7, energy. I totally not only decreased my exposure, I diversified laterally and vertically. And sort of kind of change the makeup of sort of kind of what I do and how I go after stuff. I've definitely neglected the dividend end of trading, no doubt. Just like I neglected the S&P, and slowly learned that I needed to diversify among all markets, among all asset classes. Well, this is just another evolution of that whole idea. So let's continue on. That was today. I sort of bought before 12, a little bit after 12, and I was happy. I decreased my share cost amount and increased my share amount. Definitely. This put me in a more secure situation as far as any politician, any deal made totally screws up your trading day. I mean, traders are going to get tired of that. And this is sort of kind of my solution to that. Next chart up. If you are looking for a normal market behavior, if you're looking for normal market behavior, low cap is it from what I can see. What you're looking at now is a minor sell off of NSYNC, ENSYNC. It's traded on the AMEX, American Exchange. I was a part of my diversification, trying to get into as many markets as I can. Not only that, it was totally time to buy. The 12th, about 12 o'clock. As you can see there, it dropped. And early this morning, I just been waiting for signs of it dropping any further. It didn't, and I went ahead after I did a shuffle out of mid cap just to take advantage of the early morning market. I went ahead at like a little bit after lunchtime, sheltered in the penny stocks just because I didn't want to go 100% into cash. Nobody knows what's going to happen tomorrow. I'm sorry, no one does. Next chart you got in front of you is American Holdings. That was on the 12th yesterday. Um, it's another stock I sheltered in that I was holding this morning on the 13th. Reducing overall exposure, growth potential, stability, liquidity needs to be a foundation in any portfolio. Being able to reduce exposure in the lateral, increasing share volumes and reducing share price is a sure way of doing that. This was on the 8th, and as you can see, the Dow Jones was definitely lagging. And first, all this week, Monday, the Dow Jones slowly lagging. Today, it, sort of kind of caught up to the rest of the group there. The last fourth of trading, the dollar looked like a piece of bait. That's what I'm showing you right here. A sheep in an Irish spring. MACD is clear. The end of trading, a small dump by Forex traders at the end of operations. It's clearly shown, only for it to bounce back again at the very end. It's the aggregate of really what happened Friday. Swing trading global. Trader confidence is holding the line. As far as too much exposure, there's too many players with skin in the game. The dollar is still accepted worldwide. As far as a yield curve inversion is concerned, we know the world economy is in a slowdown, no doubt. Dumps and early payouts. The world can't operate without U.S. credit. The liquidity bull continues with stocks at highs. The power of tax reform, could it be? Emerging market issues, a non-event for stocks, meaning some of the small companies I just involved myself in. That's a big question mark. A trade war between the U.S. and China has a different impact on prospective stock markets. U.S. domestic political issues do not cause selling. One factor can break the back of the stock market. One factor, that is, and this is what they say. Last week, the bull run in the stock market, if you want to call that a bull run, officially became the longest in history since the beginning of 2016. We have witnessed 4 occasions where stocks corrected to the downside. In early 2016, stocks dumped on the back of selling in the Chinese domestic market. Selling in the Chinese domestic market. Selling off U.S. treasuries? Well, they just bought some. Crash not going to happen. Truthfully, China bought U.S. treasuries along with Japan. The reason why China would do that is if they had no choice. The stimulus of the U.S. dollar is that suicidal. It's like pushing someone off a cliff. The dollar is not asking for buyers. And as you can see, the most attractive currency in the world, there's the dollar index. The top graph or chart shows just convergence for a quarter of the trading, almost that whole day. And there you go again. There it is. In the KDJ, I want to get that right. You just see total convergence. In the MACD, all you see is just sitting in a wave of green. These were the dumps. These were the sells or buys, puts, shorts. Boom, boom, boom. There you go. At the bottom one, and people made money off of the dollar, and it's remained stable. It was used a little bit. It's a staffing company. They announced new leadership. As you can see, Hendricks Struggles announced new leadership. Jenny Hiblet, Dan Ryan, swap places. And these are commodities on that Friday with a strong dollar. I wanted to point this out. A very strong dollar. These are gold miners doing very well. Obviously, the price of silver was driven. With a strong dollar, it should be driven down. In this case, it went up. A strong dollar basically caused an anomaly in commodities, and this one of the few times I've seen this. It's happened before, but when the dollar is up and commodities are up, I think this is a side effect from China pulling out real estate and taking it out of real estate and moving it into U.S. Treasuries. The Chinese government can trade in the U.S. market, but they're making it harder for their citizens to do so. This is a case here, number 9. Sandstorm outperformed all of its rivals with 50% return since November. The company announced a share buyback program on November 15, 2019. I think that this event alone has changed the market sentiment about Sandstorm. The latest royalty acquisition added a near-term cash-producing asset, increasing the company's net asset value with no dilution to the shareholders. In the last weeks, gold prices went up to 8%, and all the royalty companies but one had positive returns in this period. Sandstorm outperformed all of its rivals. $17%, $3. Well, no, actually 17 cents at 3 point, and that's what I'm talking about, 3.8. It would be nice if they would have gained $3. These are the gains that they're talking about in this market. 3.8%. 17 cents. Big rally, right? Now, let me check. This was on the 8th. Where is it at on the 4th? It's either down by that much or more. There's no earnings in some of these companies dealing with some of these asset classes. There are, but they're very little. There's something on Ford, and they looked real good on Friday, and they look good today on the 13th. I'm pretty sure the CEO of Ford is pretty happy. Ford's venture with China fell 54% to 378 units last year amid the slowdown on the world's largest car market. Ford has stabilized after being down. The opportunity gives investment time to earn a real active yield. As you go, DDK, Friday, big sell all through the day. Boom. Just read it there. That's the MACD. Same kind of thing. Just the field of green. Most of Friday. Same thing here. This is Barclays, which I sheltered in Barclays for a second, making some moves. Barclays is ramping up their internet portfolio by appointment of Riaz Latherhoy. He will see his last job. We will see his last job was at Deutsche Bank, Germany. Also, Barclays announced the launch of a Colony Capital Fundamental U.S. Real Estate Index. I still treated them just like, whatever. Is Barclays really going to be a part of a strategy? I mean, Deutsche Bank is more of a strategy, financial strategy than Barclays by far. There's so many REITs out there to choose from. I think ProShares outperforms Barclays. I mean, I just put that there because I held it for a while, sheltering a little bit. Here we go with AMRN. I forget the name of the full company, and I held these guys Friday, and that's what they did for me. Didn't mind holding the stock for a little bit. Okay. It is well known to the investment community that REITs have historically been one of the very best asset classes to invest in, especially in the past 20 years. REITs have literally crushed the returns of every other sector with annual returns exceeding 12.5%. Retail ETFs are down. This was Friday. eBay was up 0.03 hundredths. Ford was up 0.96%, and GM was up 13%. This is my big thing with Ardman. That's SEPA breakthrough, February 8th, closed Friday, $16.08 is the 52-week high, is 17.08. Note, if the drug is a big breakthrough, why wasn't the 52-week horizon achieved when the market was supposedly doing so well? At top, you got my two favorite REITs, DRV, DRN. I can jump in and out whenever. These are just some of the REITs or some of the slowest moving stocks you'll ever see. Definitely part of my portfolio. Real estate, DRV, DRN. I think we'll just go to the top. This was on the 10th, just 2 days ago, Monday. It's week 41. February 10th, day 41, week 7. My fault. Stock operations, stock review. 52-week horizon on that day was the 4th January, which was early last year. As you can see, what the Dow Jones looked like Friday, and the abstract of the whole thing is smaller stocks outperform large stocks. 27.5 trillion total market capitalization in all U.S. markets. The companies that are majority of the market are right ahead of you. Apple, Microsoft, Google, Intel, Amazon, Facebook, Berkshire Hathaway, and Alibaba. I don't think you know the rest. what really affected trading late last week was China and Japan buying more T-bonds, BNDX, BNDWTLT. China's sprawling service sector maintains solid expansion, CNY. Renminbi at 0.0 hundredths of a percent. There's the KDJ, there's the MACD, on BNDX, it's sort of totally opposite, inverted from the dollar, right? I should have given you a side by side on that, but here you go. This market vectors is something I held for a second. Pro shares, ultra short, industrial and utilities was down 1.9%. Both traded, or 1.19%, both traded on the Dow, closed at 63.20. Sort of kind of almost a 25% change from its 52-week low. 25 hundredths of a percent, basically. Reason why I'm really getting into the renminbi is because it's the dollar's competitor, basically. So what I'm trying to say here is the RMB is, roundabout terms, I would say 25% under the dollar's value right now. That's why they needed to get dollars. Or should I say treasury bonds? Because their currency is comparable to our treasury bonds. And that's what makes this whole thing go. Let's go get back into it. Chinese shift cash from U.S. real estate to shore up its economy. They sold off $854 million in assets here in the U.S. Commercial real estate. The Chinese government is restricting foreign investment by consumers, while the Chinese government have increased their investing in the U.S. DRV is lower at 0.02 hundredths. It's 26 hundredths of a percent, while DRN is at 23.74. Its 52-week range is $24.41. Expect a swing for the downside in real estate. DRV should begin its ascent in 2 weeks. There's your bond there. It's traded on NASDAQ. So to wrap it up, still more work to do. Tons of more work to do. And basically, This is why I bought it. This is why I bought Insync. I mean, imagine that stocks that are behaving like stocks. Truthfully, you know what I'm saying? Stocks that are behaving like stocks. Started high in 2007, right after the crash of '06, right in there. Let's see what the month was. Didn't say, just says 2007. Obviously, we're looking at the max. And you see from 2007, it is going down. Very naturally. Why would I be looking for something like this? Well, basically put, we're reaching near 2007, 2006 environment. When people are just trying to find a place to put their money. This is where we're headed. You see it right now in the stock market. It may not take a turn it may not take a downturn for quite some time. I think it's bad for everyone that it's not a natural ascent to its horizons. A lot of these stocks never going to reach their horizons in their 52-week cycle. But what you can do, as far as I'm concerned, is go back in history far enough and you'll find a company or two that enjoys that kind of environment of liquidity and have the receptors to accept it. Still have a lot of upward mobility and growth in their industry and in their business. Here's Skies on the NASDAQ. Another one of these small stocks I sheltered in. And like quadrupled my shares. I mean, in the market. It's just all a part of that inflation. I'm not trying, in a way, I'm trying to take advantage of the inflation. Meaning spread as many units across the market as I can, at this point. Just continue on. We'll just peep it and take a look at stuff. A couple of the choices I made. Convergence, most through today. So the MACD. Trying to find something in the red, but something that's not dead. It's a difference. I want to buy in the red. I want to buy when it's down. Yeah, to a point. You don't want to buy a company that's dead in the water. You know what I mean? And all these little stocks, they fit this bill. They fit this bill, at least for 25% of their portfolio. I'm not saying do 50. I wouldn't do 50. But I would do 25. Instead of sheltering in cash. Because you don't know what these guys are going to pop off at the mouth next. That throws your model totally out of whack. This is another one. Totally diversified this guy. It's just that simple to me. You see what I see. A long time ago, not that long ago, this is the yellow and blue lines is how I correlate it, and what it's doing now. It has a history of reaching higher. Given the right environment, it will go higher. Let them keep inflating the market, and I'm going to try to spread the balloon as far as I can. You know. Anyways, I think you guys totally understand where I'm coming from on this. Thank you for watching Stock Review. These are the applications. I'm going to start bringing crypto online. I've always sheltered in crypto. Not always, I've done it. And I think it's time to start thinking about that kind of thing again. Yeah. And I should have had the screen open. Since this password, I'm not going to bring it up right now, but you'll start seeing that. Definitely. These are the applications. These are the concepts. These are the stocks. I don't hope this has been informational for you. I know it's been informational for you. The further and further I continue on with this, the more and more I'm not going to incorporate any other input from any other shows on this show. I just don't think it's more. I don't think I need it. Except for a few guys out there putting out educational stuff. As far as the rhetoric that's put out on the show, take it with a grain of salt. I took a bear position on Thursday, and it took me all the way until today to not only get out, or it took me till Monday to get out of it. It took me till Wednesday to actually come up with a new strategy. It's not, you can sit there and trade and get out of harm's way, not lose your principal by the skin of your chinny chin chin, but that's not good enough. You want to be able to emerge from a learning situation with a new strategy. That's what I've been working on. I'm sorry about the delay. This is not a show where I'm going to hold your hand. Please like, share, and subscribe. And of course, in the description, I will leave the link to the transcripts where you can look at this for yourself. Please like, share, and subscribe. Appreciate you tuning in to Stock.